In this project, we will advise investors interested in Tokyo Nikkei Stock Exchange. We will use historical data from September 1st, 2012 to September 1st, 2015 to forecast the expected return of our portfolio on a 2-year horizon, from September 1st, 2015 to September 1st, 2017. The first step is to choose our 5 stocks, based on the historical data from September 1st, 2012 to September 1st, 2015. We use the application screener from Reuters Thomson to filter and pre-select our stocks based on their headquarters, that should be in Japan, thus should be in the Tokyo Nikkei Stock Exchange, their market capitalization is in the top 20, and to diversify our portfolio, we added some filters about the industry to choose stocks from different ones. The closing price on September 2015 should be higher than the closing price in September 2012. We pre-selected 5 stocks by taking the 8 stocks with the highest market capitalization. From their weekly return in the historical data period, we calculated the average return for each, as well as their standard deviation, their Sharpe ratio, using Japanese government bonds as risk-free assets, and their correlation coefficients between themselves and with the market. Based on these 3 assumptions above, the first being positive average return on the historical data period, second, that we keep the 5 stocks with the highest Sharpe ratio, and third being that we want to diversify a portfolio as much as possible. We selected 5 stocks: Toyota, SoftBank, Sony, NTT, and Takeda, which operate in the automobile industry, telecommunication, pharmaceuticals, and electronics. To note, we assume that our investor wants to stay in Japanese security market, which is why we consider Japanese government bonds as the risk-free asset. Then, to calculate the volatility of our systematic risk of our securities in comparison to the markets as a whole, we calculated beta using the classic valuation methods and the linear regression method for more accuracy. Using Solver, we studied which portfolio using these 5 stocks would lead to have the optimum return to risk ratio. This can be calculated by looking for the highest Sharpe ratio while using the matrix of covariance of the different stocks and the expected return of the different stocks. We found that the optimum portfolio would be to have 67% of Takeda stocks, 21% of NTT stocks, 10% of Sony stocks, 2% of SoftBank, and almost none from Toyota. The solver did not suggest short any of the stocks. Using Solver again, we used it to quickly model the portfolio. The slope of the capital allocation line is equal to the Sharpe ratio of the optimum portfolio. Then, we studied how the risk-free asset could be added to the portfolio. The risk-free asset that is the most relevant to the portfolio in Japan is Japanese government bonds. These bonds had, between 2012 and 2015, an average return of minus 0.2425%. As it's a risk-free asset, Solver would have suggested to invest 48.87% of the portfolio in it. However, even though it reduces the volatility, hence the risk of the portfolio, investing in a risk-free asset with negative return, because the return was minus 0.2427%, would mean to lose a lot of money for the investor. Therefore, knowing this and with comparison to our complete risky portfolio, we advise the investor to choose the portfolio without risk-free assets. If we were to compare the portfolio of the different stocks in the portfolio without the risk-free asset and the portfolio with the risk-free assets, we can notice that the proportion is not exactly the same. However, they are very close and follow the exact same order of importance. In any case, by not choosing the portfolio with risk-free assets, the composition of our previous risky portfolio will remain the same. As we decided not to take any risk-free asset, we will now forecast the return of our portfolio in 2017, 2 years after our previous calculations. We know the weight of each stock in the portfolio and their expected weekly return. To forecast the return in 2 years, we need to elevate the expected weekly return to the power of 104, representing the 104 weeks into 2 upcoming years. By weighting and summing these returns, we get the expected overall return of our portfolio. Then we calculated the actual return of our optimization in 2017 and compared it to our previous results. The actual return wound up much lower than the expected. To be more accurate, we took into account the standard deviation, and so we created an upper and lower forecasted return with 95% of certainty. But once again, the actual return did not take place in the confidence interval. We conclude from this that our forecast did not prove right in 2 years later. There are many reasons to this: the cyclicality of the Japanese market, the situation at the beginning of the study, which was after Fukushima event, and the current economical and geopolitical situation of the country. If we had invested in the portfolio in 2015, we now should keep it until the next cycle top.